Hello, Kevin.
Hey Charlie,
Welcome.
how you doing?
Good, good. Welcome again to an opportunity for us to speak to all of our clients out there on what's going on lately in the economy and the markets. Possibly, it's been a little bit of a rough road lately, so we thought we'd get together and kind of try to provide some news, some perspective, possibly. So as we know that it's not easy, investing is not easy these days. That's for sure, Kevin.
Yeah, the dialogue that we hear a lot, Charlie, is that things are crazy right now. World's crazy right now. There is a lot going on in the
Mhm.
world, but when markets go down, from an investment point of view, those things that are happening in the world seem even worse than usual.
Mhm.
So today we just wanted to try to give a few ideas about how to deal with down markets. What can we do as people to deal with when things are not going the way we hope they will. And so the first thing I wanted to talk about today is a little bit of history in the
Mhm.
market. So I'm going to share my screen here, and we always love to show these charts over longer periods of time.
Mhm.
So if you were an investor going back 25 years right now, and you looked at what your return was per year, it's 7.5%. Now, that's not 10%. That's not the returns of the last few years, which have been 15 and 20%, but that's still 7.5%. And Charlie, the rule of 72, how
Mhm.
many years would your money take to double during this 7.5% run here? Any
I'm going to
any
say
guess?
about 10.
Yeah, that's great. Yeah, 72 divided by 7.5 is
Mhm.
we can just say it's 10. So every 10 years, your money would have doubled in this time period. But as we sit here today, we look at what's happened recently and we say, oh my gosh, this is horrible. The
Mhm.
market is terrible. What I would like to first remind people is we've had days like this before. Okay, so in the Corona crash,
Mhm.
we had a market drop of 34%. Went down very fast. We had a drop. This was actually down 53%. I think this is looking at just a certain time period, but the
Mhm.
S&P 500 was down 53% in 2008. And then the tech bubble, if we add in the NASDAQ, it actually is down even more. If you were a
Woo.
NASDAQ investor back in
Oh,
2000, Charlie, you would have been down
yeah.
67.54%. So, right now, as we sit here, I think we're down about 22, 23% in the S&P. Foreign
Mhm.
markets down 25%. So these things happen. I think that's
Mhm.
the first thing we want everybody to know is that Charlie and I, even though we realize these are not fun, these are a part of investing, and these are part of the reason why you get higher returns over long
Mhm.
periods of time, because you are going to go through these situations. So, Charlie, we use the word discipline quite a bit when we talk with clients about our investment
Mhm.
beliefs, that you have to have discipline. What does discipline mean to you?
Yeah.
When markets are quote unquote going down, why would we want to be disciplined?
Yeah. Before we invest, for our clients especially, we see the data that you just showed, and we know that we're going to have down markets, kind of like a thunderstorm in the summertime. We know those are going to happen. We just don't know when. We don't know how severe, but we know that they do happen, just like the graphic you just showed. So we have to start the investment process with a plan, and we call that our investment policy statement. We talked about that before we started recording here, how important that is to say we are going to go through some hard times together, but here's the plan. Here is the evidence that we have to build this plan. So I think, Kevin, when we have that well thought out plan, when we take the time to look at the evidence, and then we start going through these difficult times, that's why we say stick with the plan and have discipline to do so, because it's well thought out. It's not a randomly kind of constructed thing. So all we need now to do is have discipline and understand that the investment plan was built for these times, with these times in mind. And so the action has already been done. And again, I think the thing left to do is have discipline, have a little belief that it was well thought out, and that's been proven to be the most profitable strategy, is to maintain the discipline during those times.
So, Charlie, your comments about discipline, I think, are very important. How does the mix of asset classes may impact portfolio performance? Asset allocation is the big one.
Mhm.
Stock selection, not so big as long as you diversify, Charlie. And then market timing. Market timing is a very bad strategy. And I don't want to say it's funny, but it's at least interesting to note that
Mhm.
whenever we talk to clients about the fact that we're not market timers, they say, yeah, I get that. I get
Mhm.
that. You guys are not going to try to time the market because
Yeah.
it's so hard to time the market. But what we are wanting to do right now is to sell everything and then get back in later
Yeah.
when things are lower. So
Yeah.
that is market timing. And so, yes, we knew this 2022 type drawdown was going to happen.
Mhm.
We didn't know exactly what was going to cause it. We didn't know when it was going to happen. I wish
Yeah.
we did. But the other issue I think that really clients are very worried about at this time, Charlie, is that, yeah, it's down 22 to 25%. What if this is the big one going
Mhm.
down 50,
Yeah.
60%? What if this is the big one?
Mhm.
You know, I want to get out before the big one. And that's really, I think, where people are more concerned. What do you think?
Yeah. I think it's a natural idea. In fact, market timing is a reasonable idea. It makes sense, right? Intuitively. Let's just get out and wait for this thing to be over. The very thing that's easy to miss though is in the execution. It just doesn't work that way as far as getting out, because when we get out, we sell those investments, or we become more conservative, which is kind of a nice way to say, let's sell everything. We lock in those losses, and those become real losses. Most of the time, Kevin, the stock market, the way it behaves is at the very bottom or at the very worst of times in the markets are the times when you get the biggest spurts, the biggest returns. They come in clumps. They come in very few days. And if you miss those days, you're not going to get those returns back. So that's the part of execution that becomes nearly impossible. As we've seen, you showed the statistics earlier. Market timing is not effective, and it cannot be done consistently over time. Somebody might get lucky and do it once, but it's not going to happen consistently over time. The other thing, Kevin, about market timing is it's stressful to stay in the markets. We want to do something.
Right.
And I tell folks, hey, there's lots of things we can do, but all the options are worse than what we're doing right now. Because we've already, again, thought about this and developed the plan. Every other option right now is worse. And one of the things that I think we've seen this experientially, is that it's worrisome to be in the markets when they go down. It's hard. It's not easy. But when you have a plan and when you have an understanding, maybe it's a little easier. But when you get out of the market, guess what, Kevin? We just replace one worry with another. Because when we're out of the market now, when do we get back in? There's no signal. Now there's no plan whatsoever, because there's no signal out there that says, hey, it's all clear. And if we wait for the all clear, the investment gains have already come and gone, and they cannot be recaptured at that point. So that's where the execution makes it a very difficult to next to impossible kind of strategy.
So right now, everybody has a portfolio that they own stocks and bonds and other things maybe. The value of those items are down.
Mm-hmm.
But what do people own other than the negative 20 whatever percent on their screen? Do clients still own what they owned before, or what's happened in the last 6-9 months?
Yeah, I think what you're talking about possibly is that, hey, look, we still own great companies. We still own companies that produce products that'll be around through a recession. They'll be around, for every kind of economic environment. We're going to need some of these things. We're going to need some of these things that the companies produce. Now, on your screen here, what I've pulled up is just a sample of companies that probably all of our clients own to one extent or another. And these companies are great. They'll continue to be around. Some of them, like AT&T, have been around for, Kevin, I don't know, 70, 80 years plus. Some of them may not be around, but that's why we own thousands of companies all across the world. It happens to be right now, the prices of these companies are going down, and that is partly based on fear, partly based on people fear and some emotions. But these companies are still really good companies, and our clients and ourselves, we personally own thousands of companies just like them. So I think that's something important to keep in mind.
Absolutely, Charlie. So we also talked a little bit before we jumped on here how tomorrow seems very gloomy.
Mm-hmm.
And today is gloomy. Markets are down. Still a war going on in Ukraine. Still, inflation is really hot. Recession looks like it's coming. Really, the question I would ask everybody is what happens if we're wrong about how gloomy everything is? What happens if sooner rather than later we're wrong? What happens if everybody is right? I guess is the first question. Have stocks already and bonds already priced in the fact that everybody already knows what's going to happen? What are your thoughts on this, Charlie?
Yeah, it's hard to disconnect sometimes the economy and the stock market. And sometimes they go down together like seemingly they are right now, but they're not always in lockstep with each other. In other words, we could continue to decline as an economy. And as you said, the stock market could go up. It could be better in one area and not the other, which is really hard to distinguish and hard to remember. But that is absolutely what could happen. In fact, the S&P is what some people call a leading indicator. In other words, it prices in things that may happen in the future. And so we've got to keep that in mind. Just because we believe the economy may get worse, it doesn't necessarily mean the stock market will. So we have to be open to the possibilities that tomorrow could be better than today. And that's really hard to do. It's hard to do.
Yeah. Going back to 2020, I mean, I remember so many people talking to us, Charlie, and saying, this COVID is different. It's going to be miserable. It's going to ruin the financial markets. And it was miserable.
Yeah.
And it was an awful time. But for some reason, it didn't ruin the financial markets. The markets eventually came back. And so markets do discount in, especially like you said, when we're fearful, markets discount in a lot of bad news. So what happens if the news is actually better than expected tomorrow? It's possible that the markets could do better. But right now, Charlie, and this is the thing I've heard from a few people, not a ton, but just like, hey, the market is going down. Everything is terrible. There's going to be a recession. There's like 17 other reasons why we should get out of the market. So why do we stay invested?
Well, we stay invested because we've planned for these moments, and it's not perfect because markets do go down and we know that they go down. But if we remove our investments from these companies that we just showed on the screen, then that means we've locked in real losses. It also means, when do we get back in the market? When do we buy those companies again? And so that's a huge unknown, Kevin, that will not be, there's no magic signal. There's no bell that starts to ring when the time is to get back in. So that's where the difficulty in execution comes in.
So Charlie, let's talk about people that are 40 years of age or 50 years of age or 60 years of age. This loss of 22%, let's say, for someone that's 100% S&P 500. How do they deal with that? I mean, it's very painful right now. September, about to be October of 2022. This is very painful. What are the things that we can tell ourselves to get through this time as far as that feeling of a real loss right now?
Yeah, I think that for me, it just helps me to know that I still own companies. I'm an investor. I own companies, and I own the part of the future profit of that company. And right now, to me, the future returns of some of these companies is better. I kind of look forward and go, hey, I'm a long-term investor. I own these companies because the future of some of these companies is bright, and they're going to make money one way or another. They'll find a way, and I get to share in those earnings. And so for me, that means I got to put aside a lot of the stuff in the news about the economy, which is terribly frightening sometimes. What's going on in Europe, it's scary. Inflation. I'm an investor. I like to own assets. These companies are great assets. I really don't even like to own real estate anymore, Kevin. We talked about that. Some people like to own real estate for the same reason. It can be a great investment. I just want to own great companies because they make money, and through good times and bad. Now, the tough part, I think, is separating that economy from the companies that I own, differentiating those, spreading those apart from either my political beliefs, what's going on in the world, what's going on in the economy, whatever hurricane's coming up. I own companies. I want to own them for the long term because they're going to earn money. I get to share in those profits. It's really almost that simple, Kevin. But it's hard to stay focused like that.
Yeah, those are great points, Charlie. I really like what you said there. I also want to answer my own question and say that what I think is really helpful is not to say I've lost 22%. I think it's much more helpful to use the internal dialogue of my investments have gone down by 22%. And I'm not going to use the money until whenever.
Yeah.
And it's just a short-term downgrade of the price on my investments, but they'll come back. I think that's extremely important for us to tell ourselves that.
Yeah, yeah, absolutely. And, you know, just for our clients out there, I mean, this is a good time to take inventory, to do some self-reflection. And if somebody's not sleeping well at night, let's have a discussion. Let's talk about it and let's learn from that. You know, now is a good time to evaluate our risk tolerance again and just have a discussion about it. And maybe there's some perspective out there that can help, because we certainly don't want people to be afraid because of some news that they may have heard. And so I think we can add perspective and help with that, Kevin.
I think it's really important if you've gone into a market crash and you found yourself being invested too aggressively. What we have to do is look at when you're going to need the money. I think that's the key. Go through the process of saying, when exactly am I going to need the money? And probably you don't do anything. But if you're really, really having trouble, I think the first exit ramp, if you will, is you can maybe sell 5 to 10% of your most aggressive holdings. And it's not going to destroy your financial plan, but at the same time, it gives you the feeling at least you've done something.
Yeah.
But again, I think it comes down to, well, hey, this was a great lesson, very painful lesson. And in the future, I'm not going to be as aggressive when stock markets are going back up again, because they will.
Yeah, that's right. Absolutely, Kevin. So hopefully this message is helpful. And again, we just want to provide some perspective. We know this is challenging. After all, it's one of the only reasons there is a return in the markets, because they don't always go up. There's risk, and we're feeling that pain right now. So, you know, we hope that tomorrow it gets better, but we don't know. There's a lot of uncertainty and a lot of volatility out there. And so we'll keep you posted.
Yeah, Charlie, my last comment is that, you know, short term, you can be pessimistic and be an investor, but long term, being an optimist is really not only helpful probably for investment returns, but it's also much more enjoyable. As you and I believe that the markets will go up again over time. And that's the reason why we got into it in the first place.
That's right. Yep, absolutely. Well, thanks so much, Kevin. We appreciate it. We appreciate you, our clients, and please don't hesitate to reach out. And if you'd like to schedule some time, then please do so. Give us a call. You know our numbers, and we look forward to hearing from you and talking to you in the future. Thank you very much.